The boat market is breaking, and dealers are panicking right now. Prices are plunging, lots are jammed, and every unsold boat is burning cash by the day. Those big discounts you're seeing, they're not deals. They're distress signals. Interest rates are up. Buyers have vanished, and the same banks that fueled the boom are calling in their loans. Repos are stacking, values are sinking, and it's getting ugly fast. Here's what's really happening beneath those shiny price tags. The discount no one should celebrate. Dealers across the country are slashing $30,000 to $40,000 tags on brand new boats, not because they want to, but because they have to. Listings that sat at $189,000 just a few months ago are now showing at $165,000. Screenshots from major dealer sites prove it. Identical models are sitting side by side, with 10% markdowns compared to mid-2024 pricing. At first glance, it looks like a golden opportunity. But those discounts aren't generosity. They are distress signals. The reason is buried in how these boats are financed. Each one sitting on the lot is tied to a floor plan loan. And every day it sits unsold. The dealer pays interest. The longer it sits, the deeper the debt hole grows. To the casual buyer, a markdown means savings. To the dealer, it means survival. Those big red stickers are not deals. They are lifeboats. And when desperation starts dictating prices, depreciation accelerates even faster. A shiny hull today can be worth 10% less the moment you tow it away. But that markdown isn't generosity. It's a pressure valve about to burst. Lots packed, ledgers bleeding. Drive past any marina row or coastal highway, and you'll see the truth written in fiberglass. Boats are jammed so tightly you could walk from one bow to another without touching the ground. Dealers ordered like it was still 2021, and the shipments kept coming long after buyers stopped. Now, those lots are parking lot prisons for unsold stock. Floor plan rates that once hovered near 3% are now sitting between 7 and 9. That difference turns every unsold center console into a monthly bill measured in hundreds, sometimes thousands of dollars in interest. Dealers are bleeding quietly, many of them paying more in finance charges than they clear in profit per unit. To protect margins, they fold those costs back into what you see as a sale price. So that shiny discount might already include the dealer's loan pain built right into it. Every hull on display represents a small financial clock ticking down to the next payment deadline. This isn't a normal slow season. It's a cash flow chokehold tightening by the week. So dealers owe before you ever make an offer. And that's fueling the next problem. If this breakdown is helping you see what's really happening behind those sale signs, hit the like button so more buyers catch it before overpaying. And drop a comment. Are dealers in your area cutting prices this hard? The buyers who vanished. The other side of the equation is demand. And it has fallen hard. Bank bulletins show credit approvals for marine loans dropping by double digits compared to last spring. During the pandemic boom, lenders were offering 5% rates and easy terms. Today, even well-qualified buyers are staring at 8% financing and tighter requirements. For retirees living on fixed income, those monthly payments have doubled since 2021. Inflation pushed fuel, insurance, and slip fees higher, forcing many would-be buyers to step back. The result? Showrooms are quiet, even on sunny Saturdays. Sales managers whisper about traffic droughts. For cautious buyers, this shrinking crowd means leverage, but only if you play the timing right. The fewer approvals the banks issue, the more desperate the dealers become. Yet patience matters. Step in too early, and you could catch a falling knife, paying more than what the same boat will list for a month from now. Step in too late, and the clean units will be gone. Timing, not temptation, protects your wallet here. Which brings us to the bills the banks don't talk about. The repossessions. Repos rising. Values sinking. Behind the showroom glass, another story is unfolding. Repossession yards that once held a handful of boats are now lined with rows of late-model pontoons, cruisers, and waitcrafts. A leaked lender memo shows defaults climbing by roughly 15% year over year, and the trend hasn't peaked. Many of these owners bought at the top of the market in 2021 or 2022, financed for 15 or 20 years, and now owe more than their boat is worth. When rates climbed and maintenance costs rose, the math stopped working. The bank tows it, lists it at auction, and those auctions set the new price floor for everyone. A repoed boat selling for $120,000 instantly resets the market value of every identical model on a dealer's lot. That wipes thousands in equity off honest owners who kept paying. It's a vicious cycle. Falling values trigger more defaults, which flood more repos, which drive prices even lower. For buyers, it's the best deals in years. For sellers, it's quicksand. And when repos flood auctions, dealers panic for real, and factories notice. The floor plan time bomb. Every boat sitting on a dealer's lot is quietly costing money every single day. Those costs aren't just electric bills or property taxes, they're floor plan interest payments, and they turn unsold inventory into ticking financial grenades. A dealer finance sheet obtained from a Gulf Coast retailer showed that one $200,000 cruiser racks up roughly $1,300 a month in carrying costs. Multiply that by 40 or 50 boats, and you can see why the math stops working fast. Each of those loans functions like a taximeter, running whether or not the boat moves. Dealers try to offset those charges by tacking on mysterious dock fees, prep charges, or admin costs that often add several $100s to your invoice. The longer a boat sits, the higher those hidden fees climb. Some dealers quietly rotate inventory between locations, hoping to reset their loan terms, but the interest doesn't disappear. For buyers, this means the price on the window might already include weeks of the dealer's debt. When those fees hit redline, dealers start cutting corners. Creative math at the showroom. Walk into a dealership today, and you'll be greeted with banners promising zero down or free electronics package deals. They sound like gifts until you read the fine print. A 30-foot bow rider listed at $175,000 may look like a steal when the salesman says you can drive it home for nothing up front. But behind the scenes, that offer stretches your loan term from 10 to 20 years and bumps your rate from 7% to nearly 9%. That means paying nearly 20% more over the life of the loan. The free gear bundle? It's baked into the final sale price. Dealers are using these tricks to make slow-moving inventory look affordable while keeping monthly payments deceptively low. Many buyers never notice that they've paid for every perk twice, once in price and again in interest. Others fall for inflated trade-in values that later reappear as delivery fees. The tactic keeps cash flowing long enough for dealers to service their floor plan bills, but it quietly shifts the burden to you. Those tactics keep the lights on. But upstream, factories are slowing the flow. Factories hit the brakes. Manufacturers have begun to react. A trade bulletin from one of the largest U.S. builders announced a second quarter production cut, citing lower retail activity and unsold pipeline volume. That's corporate language for too many boats and not enough buyers. By early spring, at least 3 major brands, including 2 luxury names and 1 mid-tier producer, had trimmed schedules by as much as 20%. The move is designed to give dealers breathing room, but it creates new pressure points. With fewer runs, suppliers face cancellations, and warranty parts slow down. A technician in Michigan said that what used to be a 3-day part order can now take 3 weeks. If you're buying, that means repair delays and limited support for newer models. Dealers quietly admit that fewer boats rolling off the line helps stabilize prices, yet it also freezes cash for everyone tied to the chain. Lower output sounds healthy on paper, but it's a sign of contraction, not confidence. And that slowdown ripples through the towns that build your boats. The ripple through real people. Behind the headlines are the workers and small businesses caught in the middle. In Elkhart, Indiana, often called the heart of the hull, local news reported several hundred layoffs among suppliers that mold fiberglass parts and marine interiors. Trucking companies hauling boats from factories to dealers are running half-empty routes. Even nearby diners feel it, as lunch crowds thin when production slows. Every missing paycheck in those towns means less spent on maintenance, fuel, and storage. The very services that keep boating communities alive. For the buyer, this translates into higher labor costs and fewer skilled mechanics. As experienced technicians leave the industry, remaining shops raise prices just to survive. A service job that cost $300 last year might now run over $400. It's the hidden toll of a shrinking ecosystem, a cost you feel long after signing the purchase agreement. The ripple that started in dealer debt has reached the people who built the boats, and that feedback loop only tightens as orders fade. Meanwhile, smaller dealers are running out of financial rope. Used market freefall. By mid-2024, the used boat market had cracked, and now it's in freefall. Auction data shows prices down nearly 20% from last summer. A $200,000 cruiser that sold easily a year ago now struggles to clear $160,000. Dealers admit wholesale values are collapsing faster than retail prices can adjust. The cause is simple: repos flooding auctions while buyers disappear. Each repo resets the price floor, dragging everything else lower. Trade-ins that once covered loans now leave owners tens of thousands short. Many who financed during the boom owe more than their boats are worth. This isn't a slowdown. It's a full reset of market value, forcing buyers and sellers to face new, harsher math. So how do you stop the bleeding if you already own one? Owner's exit math. For owners holding loans, the math has turned brutal. Picture this. You bought a boat in 2021 for $160,000, putting 10% down. You've made 3 years of payments, but because prices collapsed, your model now books for $120,000. That means you still owe roughly $140,000. Leaving a gap of $20,000 you'd have to cover just to break even. That's negative equity. And it's spreading like mildew across the market. Long-term loans that once made buying easy now trap owners when values plunge. The smartest move isn't to panic sell, but to know your payoff to value ratio before listing. Call your lender, get the exact payoff, and compare it to current market listings, not your memory of last year's prices. If you must sell, consider private party transactions where you control the terms instead of handing equity to a dealer. Knowledge, not emotion, decides whether you lose money or protect it. And if you're still shopping, here's where timing flips from risk to reward. 30-day window. Every dealer runs on cycles, and the next one could be your best shot. Within 30 days, many face floor plan renewals, deadlines when banks demand payoff or proof of sale. To avoid penalties, dealers liquidate older stock at real loss level discounts. One regional chain's internal email showed end-of-quarter repayment targets by mid-May. Cash or pre-approved buyers hold rare leverage. Wait until the second or third week, when pressure peaks and offers turn real. A true deal moves without resistance. Strike then, and you'll save thousands. Not by luck, but by understanding timing. Dealers would rather take a smaller loss now than another month of interest. Patience turns panic into power, and timing always beats impulse. But grabbing a deal too early can backfire. Here's why. If you want straight, proof-backed updates before the next round of markdowns hits, make sure you're subscribed. We track the numbers, not the hype, and the next few weeks could change what every smart buyer decides to do. The false bottom. Not every markdown signals a genuine clearance. Some are designed to look dramatic while protecting dealer margin. A recent listing showed a model advertised at $139,000, down from a claimed $159,000. But when you check the manufacturer's suggested price, the true number was only $142,000. That fake discount hides the fact that the boat still sits just above dealer cost. This tactic, known as price anchoring, convinces cautious buyers they're getting a steal while leaving the seller's profit intact. To tell the difference, compare similar listings within 50 miles. If they're all cut by exactly the same amount, it's a coordinated markdown, not liquidation. Real distressed deals stand out because they break the pattern. They drop irregularly and disappear fast. Understanding that distinction protects your wallet and keeps you from being another buyer fooled by optics. When you can spot the difference, you stop reacting to fear and start negotiating from power. And once you can spot the fakes, you'll see the true opportunity. Timing the bottom without guessing. You don't need insider access to know when this market hits bottom. You just need to track 3 simple signals: auction prices, factory orders, and interest rates. Every major marine downturn follows the same rhythm. Values drop, factories pause, then rates ease. The entire cycle typically runs about 18 months, and we're already a year in. A chart overlay comparing the 2008 collapse with today's numbers shows the same slope. Wholesale prices falling first. Retail prices lagging by roughly 90 days. When you see auction averages flatten for 4 consecutive weeks while factory order cancellations slow, that's the confirmation signal. Add in the moment when lending rates start to tick down, even by half a point, and you found the timing window. That's when smart buyers step in. It's not about catching the exact bottom. It's about buying during the stall before the next climb. Plan your move between the first rate cut and the next inventory renewal, and you'll buy, while everyone else is still scared. Now, let's separate safe bets from money pits. Under 5,000 survivors and overpriced traps. Not all boats bleed value at the same pace. Some humble models quietly outlast the market because they're cheap to fix and hard to kill. Data pulled from resale reports show that smaller aluminum fishing rigs and mid-90s pontoons under $5,000 have retained over 70% of their value for 3 years straight. They use simple mechanics, easy-to-source parts, and they have loyal owner communities that keep maintenance costs down. These are the survivors. The kinds of boats you buy once, service cheaply, and actually enjoy. On the other side of the ledger are the overpriced traps. Flashy wake boats loaded with digital controls and high-output engines that depreciate like tech gadgets. One 3-year-old model that once sold for $120,000 now books at $68,000, and parts are already on back order. The lesson is simple. Reliable beats remarkable. Buy the boat that spends more time in the water than in the shop. For everyone else, the smartest move right now is patience. When waiting pays. In uncertain markets, patience is currency. Historical data from the Marine Price Index and the Federal Reserve's own schedule prove that interest rate cuts typically trail the bottom of consumer spending by 1 quarter. That means if rates start easing in June, real price recovery won't show until September. A look back at 2022 and 2023 shows that buyers who waited 6 weeks after the first hint of lower rates saved between $5,000 and $10,000 on identical models. Waiting also gives lenders time to loosen terms and reintroduce promotional financing. Dealers desperate to clear old stock often add incentives once they see a genuine uptick in loan approvals. The key is to stay informed, not impulsive. Set alerts on listings you like. Track auction averages weekly. And stay ready to move when those indicators align. When patience pays, it feels less like luck and more like strategy. Because it is. And if the banks blink late, here's how to stay ready. The next 30 days. The next 30 days bring every signal together. Floor plan renewals, Federal Reserve decisions, and spring shows collide, creating rare volatility. Dealers facing lender pressure will cut prices hard. If rates stay flat, markdowns deepen. If they drop, inventory vanishes fast. Prepare now, review listings, inspect early, and lock financing before the crowd. When dealers slash 5 figures off clean models, you'll be ready. Timing, not panic, wins this round. Stay patient, stay skeptical, and let their urgency become your savings. The meltdown isn't coming. It's already here. Dealers are slashing, banks are tightening, and prices are rewriting themselves by the week. The difference between losing and winning right now isn't luck. It's timing. Stay sharp, question every deal, and don't move until the numbers make sense. Because in a market this volatile, patience isn't hesitation, it's profit. If you've made it this far, you already know what most don't. Their panic is your power. Use it wisely. Dealers are drowning, and the real deals are still coming. Don't get caught guessing. Subscribe now so you'll know exactly when to buy and when to wait. We track the data, not the hype.